We believe in having a process. The reason we created the 8-pillar process was a way of screening for companies, and this started from day one, from a natural way of me looking at stocks. I found myself looking at 8 things that kind of mattered to me. So in this video, we're going to look at 3 companies. Mo, what are they?
HPQ, Lockheed Martin, and Phillip Morris.
So on HPQ, the very first one, we're going to do a thorough 8-pillar analysis, and the next 2, we're just going to go through our 8-pillar tab over here and show you the 8 pillars from a high level. So let's get started. So HPQ. Now HPQ is a company that Berkshire Hathaway owns, and it's fallen a lot, like every company in the last year. The high of $41 in the last year, a low of 24. And that low was actually a couple times here. So pillar number 1, we want the 5-year PE ratio to be under 22.5. So we go right here on the main page. Guys, look at this. 6.24. That's a pretty low PE. So the question becomes, is it justifiably low or not? And that's what we're going to get through as we go along. Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. So same page right here, 38.3%. This is north of what Apple's ROIC is. Yeah. This means they do a great job of investing the money that's within the business through debt and equity. All right. Pillar number 3, very simply, before we go, look at this. Dividend yield on HPQ. Mo, do you see this?
Yeah.
3.9%.
Yep.
And more importantly, for those of you who are new out there, we always want to compare the dividends paid to free cash flow to make sure the company can afford it. I like to look for scenarios in which the dividends paid are less than 50% of the last 5 years of free cash flow.
This is only 25.
It's only 25%. It's $1 billion, and right above it is the 5-year average free cash flow on our software of $4 billion. So it's about 25%. It seems pretty safe right there. Okay, pillar number 3, very simply, we want revenue growth over the last 5 years. Now this one, I'm willing to bet might be positive, but not by much. Okay, so 57 billion 5 years ago, 65 billion last year. Check mark there. Now, HP is not a massively growing business, right, Mo?
Correct.
So one of the things we want to do is we want to look at acquisitions. Did they make acquisitions in order to get some of the revenue growth? So Mo, do you mind looking that up while I go further?
Sure.
Great. Pillar number 4, we want net income growth over the last 5 years. So we scroll down on the same sheet, go back 5 years ago, 4.54, last year, 6.3, check mark there. So they have net income growth as well over the last 5 years. So far we're 4 for 4. Mo, how are their acquisitions looking in the last?
So in 2015, you notice there's a big jump there between 12 and 47, 48. And there was an acquisition in there, $2.5 billion. Then there was another acquisition right here in 2018. They did a $1 billion acquisition, if I'm not mistaken. So they are doing acquisitions for growth, $1 billion.
So if you look, we find the acquisitions, scroll on just a little bit more. It's below, it's in the investing section of the cash flow statement. And Mo is showing it right here. Negative numbers means money's gone out. Positive numbers means money's come in because they've probably sold something off.
They've done a couple of sell-offs there in 2016 and 17, but not as significant as the $1 billion acquisitions.
Okay. So pillar number 5, guys, this is the silent killer to investing. We want to make sure that shares outstanding is staying the same or going down. When they're increasing the shares, which still might be a smart move, but a company that's addicted to increasing the shares is diluting you as an owner. And even if even if the company is growing, as they increase the number of shares, you're not getting all that growth. They're taking that away from you and giving it to other people. So it's the silent killer in investing. So where do we go there? We scroll all the way to the bottom of the income statement, and we go back to the 6th year, the end of the 6th year. They had 1.68 billion shares, and now they have 1.02. Definite check mark there. They have definitely decreased the number of shares outstanding within the company. They're giving every existing shareholder more and more of the company as they buy back more shares.
And I like that they're doing that even with making the acquisitions. You would think there would be.
Oh, yeah. But the other thing is, well, here's the other thing. They're paying a 4% dividend. So when they buy back shares, they don't have to pay that 4% dividend to those shares outstanding. True. 2, the company's selling for 6 times earnings. Mm-hmm. So they might sit there and say, listen, we're buying back our cheap shares and really driving a lot of value using the cash in the business to decrease the number of owners in the company. Right. So they're giving more and more ownership to the people who have stuck with it. Okay. So I'm liking this so far. Now, pillar number 6 has to do with debt. And a debt works on a company the same way it works for you individually. The more debt a company has, the more likely it is to have financial problems when times get tough. So what's a reasonable amount of debt? Well, on the main page, what I decided was I take the 5-year average free cash flow, call it $4 billion, and I multiply it by 5. That's $20 billion. I want the total long-term liabilities of the company to be under $20 billion. So I go to the balance sheet, I scroll all the way down, and right here, total long-term liabilities, $14.8 billion. That is a check mark there as well. Now, the final two metrics have to do with free cash flow. So I've mentioned it a few times. What is free cash flow? It's cash from operations, less your capital expenditures, and there are 5 things you can do with it. You can buy back shares, you can pay down debt, you can pay dividends, you can make acquisitions, or you can invest back in yourself. You can do any combination of those, none of them, all of them, 1, 2, whatever the number is, okay? Now, on the cash flow statement, we added a line so the math is done for you. And we'll show you our 8 pillars tab next. But 5 years ago, they had $3.72 billion. Last year, 4.6. Check mark there. And our final metric, similar to the PE, we want to take the 5-year average free cash flow, multiply it by 22.5 to come up with a market cap of the company that we want to buy it for. Okay, so $4 billion times 22.5 is $90 billion. So we want the market cap of the company to be under $90 billion. We go back to the main page. It is $27 billion. That is 70% less. 70% less. Now you can see why Warren Buffett and other people like this company. And here's our 8 pillars tab, like I told you. Does all the math for you. So here's what I like. This PE and this price of free cash flow means people think the company is dead and a loser. But you see revenue growth, you see net income growth, and you see cash flow growth. You see low debt, you see buying back of shares, you see all the great things here. Now, the stock is down a lot in the last year.
Yes, it is.
But could be because of where the company is in terms of being being a tech company, and there's been a lot of negativity. So let's go look at the analyst estimates here on our software. So guys, not much growth here. Analysts are calling for low to mid single digit growth in earnings. And then on the revenue side, they're actually looking for basically flat to lower revenue. Look at this, Mo. So how do we use this information? Well, we're using the stock analyzer tool. This is the tool that we created to use the model for coming up with what we pay for the company today based on the assumptions of the future, right? Mm-hmm. And the analysts can provide some sort of estimation of the future. The point is HPQ is not a growing company, but just because a company isn't growing doesn't mean it's worth nothing, right? If I were to tell you that I was going to give you $5, then 4, then 3, then 2, then 1, and then never give you any money ever again, you'd still pay me something for this cash flow, even if it's decreasing. That's the way you should look at companies. And this stock analyzer tool does not factor in the balance sheet. But in this situation, as we saw, the company has a reasonable level of debt. So it's probably going to be okay going forward. So let's make some assumptions. I'm going to do a 10-year analysis here. Mo, revenue growth, low, middle, and high.
-3.
Love it.
0.
Yep.
Go 3 on the high side, I guess.
Okay. So what Mo's doing here is he's sitting there saying, listen, on the low side, I'm going to assume they lose 3% a year in revenue for the next 10 years. That's big.
That
on the middle,
big.
What was that?
That is big, but look what analysts are saying. Analysts are saying they're going to be losing 0.5% in 5 years. So we're going out 10 years now, so I have to make it even further.
Yeah. So 5th year from now, he's saying 0.5% loss.
Yes.
Okay. Now, profit margin. The last 10 years, it did 5.3. The last 5 years, 7.2. And last year, 9.7. Now, keep in mind, in the last 10 years, the first 2 or 3 years of those, they sold off some divisions that probably weren't very efficient divisions. So I'm going to focus more on the last 5 years. So Mo, give me some profit margin numbers here.
What do you think about 5, 6, and 7?
I like that. Okay.
Same thing for free cash flow?
I would do the same thing. So free cash flow and profit net income should be the same over long periods of time. So when you see companies with very similar numbers here, just match it up. So that's what I would do. Now, PE and price of free cash flow. Guys, this is where I really want you to focus. PE and price of free cash flow, these should be representative of the growth potential in the company and the moat that they're in. The higher the growth potential, the more PE, the more multiple you should give. And the lower the growth, and the higher the moat, the more potential you give. I don't know if this company has either one. No. So I'm going to want a big discount for this company, but still give it some sort of multiple, because if I think this company's going to be around in 10 years, it's probably going to spit off a lot of cash in the next 10 years. So I pay a cheap enough price, it's going to be okay. So Mo, give me your numbers.
I would either go 8, 9, 10 or 8, 10, 12?
So I actually disagreed. I thought 7, 9, 11.
Okay.
And the reason being is this is a pretty big decrease. And who knows what happens along the way, but they're buying back shares. So it's kind of hard to say. So anyways, desired annual return. This is our last factor. Guys, if you want to invest in the long-term ETF, like SPY, VOO, you can get 9 to 10% a year. So for the desired return, to have a proper margin of safety to buy an individual stock, you need to go higher than that. This company may be a quote-unquote dying company here, but we're also being very conservative on these levels at the very low end. So, Mo, tell me your assumption levels for desired annual return.
About 12.5. You think 15, 17.5?
I think that's great.
Okay.
I agree with you 100%.
All right.
So sometimes I do 12, 14, 16, but here the company is still not exactly a booming company. So I need to get my returns by paying a super cheap price for the company. So the stock is currently at $26. I'm gonna hit the analyze button. Boom. Look at this, guys. A low of 20, a mid of 27, a high of 35. I have it set to my watch list at 22.5 only because I wanted to make sure that if it hit that price again, I get more aggressive because I have some shares of HPQ and that's not an endorsement of HPQ. I have 8 or 9 businesses upstairs. I have lots of apartment units. I generate cash flow from 10 different ways, so I can be very patient. My view is not the same as yours, so don't take my buying of HPQ or Warren Buffett's buying of it as a reason to go buy.
And if you believe our lowest numbers, it's not in the money for you yet.
Yeah, correct.
So you have to look at it and make your own assumptions and decide from there.
Correct.
So,
all right, next company.
Lockheed Martin. This is defense. So, guys, when it comes to defense, remember, there's a lot of stuff revolving around the government here. Good thing, bad thing, doesn't matter, but it is. So you have to look at government contracts. This is a very important company. I think during COVID, we were looking through the 10K on this one, doing some research, came out maybe in the too hard pile just because don't understand the government contracts. But as you can see, people love this one. Everything that Paul just went through from the 8 pillar standpoint, it hits. This is an 8 pillar thriller stock. Great PE ratio, great return on invested capital. This is important for a company like this, seeing how they reinvest back in themselves. I'm actually quite surprised about their debt. They don't have a lot of debt. Wouldn't you think a company like this would have a lot of debt? Literally labor, capital intensive business?
Yeah. I mean, I don't think it's a little amount of debt. I think it's at the high level of what I'm comfortable with.
Comfortable, but I was expecting to see like 20 here or something.
Really?
Crazy. I mean, can I just go look at Boeing real quick? I mean, Boeing's in a different situation, but I mean, and look where we're sitting with Boeing here. Oh, they don't have cash flow. Okay.
Yeah. So
that was a good comparison.
Yeah.
So, listen, guys, to me, this is a very interesting company to pay attention to. Let's see what the analysts have to say going forward. I'm actually quite surprised. Earnings per share, I mean, mid-teens earnings going out 5 years. And into the future of 5 years, they're looking at 2.75% revenue growth. I want to do a 10-year analysis on this one. This is a company, and let's look at the dividend real quick. This is a company where they pay a healthy dividend. It's 2.9%. I know a lot of you dividend investors will like something like this. It seems, Paul, look at this. They pay $3 billion out of their $5.3 billion 5-year free cash flow. A little much.
It is a little much, but this is defense contracting, and I wonder to myself, like, it's so reliant on the government.
That's the thing.
If I'm an investor, I want to get my returns some way. I mean,
it makes it a little bit more comforting, but that is a high dividend for you. So let's go to Stock Analyzer tool and put some numbers in here. Paul, what do you think about this?
The one thing I do like is it's a government contract. They're not making acquisitions, so all growth is really organic growth. Yeah.
Okay, that's great.
Yep.
Okay. What do you think on the low side for revenue growth? Analysts say 2.75% for 5 years out.
But look at that's 5 years from now. So
10 years out.
So 5 years out, it's low. It's between 1.5 and 3. Okay. So 10 years out, I would go 0.
I think that's fair. I don't think we should go negative.
2 and 4.
Okay. Profit margin.
Because remember one thing, I don't care what your political affiliation is, Democrat or Republican, they're still going to be pro-military. They're still going to be pro-war. I mean, it's not going to change. I think you're still going to have those same contracts.
Exactly.
Profit margin. Well, I think it's pretty consistent there. What it is. I would go 7.5, 8, and 8.5.
I agree with that. Free cash flow margin.
I would do the same thing.
Yep, I agree with that.
Some big jump this year in free cash flow, but I'm ignoring that. Just like I ignore the lower profit margin of the 1 year mark.
Right. Now, PE. What do you think about a PE for this one?
So to me, what's the sexiest in this business? It's relying on the government. I look at it going, I want a super cheap PE because I want to get this thing. I need to make sure I'm paying a low multiple on this thing. And that's the problem. It's currently 23 on PE and 15 on price of free cash flow. Like I was thinking 12, 14, 16.
Exactly it. I had my finger on the 12 ready to hit it.
You hit the tab button,
Price of free cash flow. Sometimes it doesn't work and sometimes it double skips. So I like it this way.
It's your Mac. Just want to make sure because it never happens for me.
Actually, it happened for me over there.
Lies.
That's when I started to do it.
Never happened for me ever.
PCs. Go ahead.
12, 14, 16, same thing. That's an absolute lie.
Okay.
He's such an Apple whore. All right. Desired return.
I find that offensive. It's fanboy.
Yeah, fanboy.
Desired return.
Right. Pardon me.
I'm going higher than 12.5% with this.
Oh, you are?
Yeah, I was thinking somewhere 13, 15, 17.
But Mo,
like
I think the 12 on the PE and maybe you're right.
Maybe you're right. Let's go. Let's do 12.5. Guys, the good thing about Stock Analyzer tool, it's a starting point. It's a starting point, and after we put these numbers in, we can always go and manipulate them and keep playing with them.
Yeah, but don't manipulate them to the point of forcing the deal to happen. I do think, like for me, government contract, more stability, secure. Like I thought 12, 14, 16.
Okay. 12, 14. Oh, so you're going lower than.
Yeah, I actually thought lower because I look at it going.
You have the security of the government.
And we've also been more conservative on the low side of things.
Okay, so guys, current stock price is 402.
Well, listen, that's what's expected.
Yeah, it's got almost fall in half. And it does make sense.
So what are the numbers, Mo?
Look at the PE. So we're looking at $171 on the low side, $228 on the high side. Look at the PE, 22.
Yeah,
and we cut it in half.
Guys, it's just math.
Yeah.
Even though the PE is currently 22, it doesn't mean that it should be. Just like the last company of HPQ,
right.
Should it be 6? I don't know. Or 4, whatever it is. It's over long periods of time. There's only so much growth that Lockheed Martin can have. And if there's not a lot of growth, then why pay a premium?
Yeah. Yep.
Final company. What's our final company, Mo?
Phillip Morris, PM.
Phillip Morris. Okay. International. 8 pillars.
Yep.
It is an 8-pillar thriller. They barely buy back shares, but still there. 17 and 14.75 in terms of PE and price of free cash flow. Very, very high return on invested capital. So interesting. $1.4 billion revenue growth, but $2.6 billion in extra income and $3.2 billion extra cash flow. That tells me they cut expenses and they maybe cut capital expenditures. Because how can you only have $1.4 billion in revenue growth, but have almost double that in net income growth? Oh my God, look at this. Dividend yield, 6%.
Oh boy.
Pays out big chunk of the free cash flow. Guys, this to me,
what percentage?
7.8 out of 9. So what is that? 85%.
Jeez.
So to me, this is my first, don't get sucked into the dividend. This is one of the first things that there's any hiccups or interest rates, and they get affected by the interest rates going up because they have to refinance their debt. This is exactly where they're going to take it out of. So don't just fall for this because of a high dividend. It's a Phillip Morris. They do cigarettes and things like that. They're probably using the high dividend to attract investors in. It happens all the time. Luckily for you, you're watching the channel now, and we're explaining to you how dividends matter as a percentage of free cash flow. So let's go to analyst estimates.
They do a lot of acquisitions. Every year they're doing an acquisition. Every 5 years.
How big are the acquisitions?
I mean, last year they did it. This year they did a $2.14 billion, then a couple $1 million here and there, $1.4 billion in 2019. So they're not major. They're not, they're just.
So in terms of EPS, there's mid to high single digits EPS growth. Revenue growth is low single digits. All right, so let's just jump right into Stock Analyzer tool. What percentage, are they expanding into other businesses?
I'm actually kind of surprised about that revenue growth that they see going forward.
Yeah.
5% in 2026.
Okay, so the company diversified away from nicotine products with the acquisition of Vectura, a provider of innovative inhaled drug delivery solutions. In 2021, the firm has 6 geographic. Okay, so they're starting to diversify away from just having cigarettes, which, by the way, we were just in Italy last week with my fiance. We were surprised how many people were smoking. I looked it up. It's only 23% of Italy are smokers, but I thought it was like half the people there.
Yeah.
I don't know. But anyways, Stock Analyzer tool. Now, okay, I'm actually going to go really conservative here. I'm going to go -2, 0, and 2%. Profit margin has been very consistent. I'm going to do 24, 25, and 26. Because remember, profit margins should go down as they struggle a little bit more. So I want to make sure I account for that a little bit here. Free cash flow margin, I'm going to do 26, 28, and 30. PE, guys, I'm going super low here. I'm going 9. What were you going to say?
I was going to go 8.
8,
yeah.
11, 8, 10, and 12. 8, 10, and 12. Now, This could be the thing we change the most of. If they diversify away from cigarettes enough. I mean, cigarettes is a dying business in the sense of they have more potential throughout the world as other countries develop, but as they get more and more developed, they tend to smoke a lot less. So just remember that going forward. There were a lot of vapors, by the way, in Europe.
I bet.
Desired return, 12.5, 15, and 17.5. Stock's currently at $87. I hit the analyze button. Okay, we have a low of 35, basically a high of 45, and a middle price of 40. So it's got to fall in half, and it makes sense with how low our PEs are. That's the big thing. Just be patient. Stocks have fallen a lot. This company was at a high of 112, a 52-week low of 83. So if you're a long-term investor and you want to buy stocks based on this kind of process, you must watch this next video in which we explain our process for what stocks we like using our 8-pillar system. Thank you very much for your time.